Welcome back. This is Chart Overload. We are Sollinda Capital Management. I'm Ryan Mumy, Chief Executive Officer, CEO. That's Justin Greenhill, our Chief Investment Officer. Like we do with these chart overloads, we're going to run through a bunch of charts and we're going to talk about what we think they mean, what they could mean, and oftentimes what maybe the mainstream news media is not talking about. So, with that, let's get fired up into the big picture. First chart comes from our friends at Investec, Jim Stack. They lay out all the crisis events going back to the 40s and 1, 3, 6, 12-month returns of the S&P 500. And of course, what we see here, Justin, is it's a mixed bag.
Takeaway is no takeaway at all.
Yeah, I mean, so many people are so certain that the world is ending, the market's going to crash 50%, gold to the moon, and yields to 8% on the 10-year. And again, we just don't know. And it has to do like with the rest of the show, all the other factors we're about to talk about, because it all works together. Next chart, obviously, oil has been in the forefront. This simply looks at the price of crude oil relative to the MSCI All Country World Index, and obviously they've been inverted since the Iran conflict began.
Yeah, one of the things to kind of keep in mind is a lot of the different themes that have really picked up since the end of last year, first of this year, have been somewhat predicated on low energy costs, right? Whether that be revival of the consumer, whether it be the continued AI rollout, et cetera. And so it's no surprise here that once oil moved that sharply to the upside, stocks went the other way.
Because it puts pressure, like you said, on the consumer and spending, and consumer spending was already depressed, and it was being offset by the AI capex, and so there's again, it throws a big question mark. You just imagine heavy braking. Let's wait and see what happens. Next chart looks at from Goldman Sachs, looks at their prime book, looks at all short exposure of index level investments in ETFs, and it's ticking up there where lots of people are kind of defensive right now.
So just think of this as basically different types of investors, big and small, would look to get short something that they think is going to move lower if the economy or the market rolls over. So could be, indexes, it could be individual stocks, et cetera. And we'll have another graphic here in the next section. People are pretty defensive already.
Yep. The next chart looks at food costs. This is back to oil prices and hitting the consumer. This is a fascinating chart we found from Bloomberg showing that with a lag effect, oftentimes the prices of food go up when crude goes up, which it all makes sense, but we never really saw it presented graphically like this.
Yeah, and this is going to be a theme we're going to kind of touch on a little bit throughout, and we may talk about it more in our quarterly webinar. But we think that the market is finally going to start to kind of make a regime shift here once this settles and start to, break down charts like this. So, yes, we know food costs are going to stay high. Yes, we know energy is, at least for the time being, higher, but that could very well, depending on the fact of the shipping situation, et cetera, that could affect different parts of the world going forward over the next 6 months or so very differently.
Much differently. Next chart looks at the production of critical raw materials, which again is in the news, less so because of what's going on in Iran, but this is still a hot button issue of, access to those critical raw goods. And what you see here is there's a lot of red, and that is China.
Exactly. So this is something that the US, Western oriented countries, and Europe have really been coming together on. And what they've come out and said they're going to do is they're going to establish a price floor. So China was previously flooding the market because they do dominate the market based on the fact that they can come to market with often, uneconomically low prices because the firms are subsidized by the government. Well, now US and Europe are going to make it such that it has to be bought at a certain price, which is just going to simply incentivize lots more of supply that might not be able to get off the ground in the Americas to start to be able to come on.
Yeah, create an economic incentive to go out and mine, which, again, as Justin said, hasn't been there. The Chinese Communist Party helped fix that. Next chart looks at, Justin and I actually talked about this before we started recording, that this is pretty fascinating. This is the share of respondents who use AI to help them invest. And, I mean, you see India at 25% of all respondents who invest use AI to help them make investment decisions, and China's at 20. And then you see the US at 9%. And again, this isn't actionable, right? But this is very interesting in what could evolve over time as more and more people start to use AI to make investment decisions.
Right. And this actually goes beyond someone just saying, like, I'm using AI to do some research or ask some questions. This is basically someone comes onto a platform and has a chat bot actually go and do it for them.
Yeah, which we've talked about this individually long form, that it creates an interesting new dynamic, but it's fairly, it would be kind of predictable. Moving on to the next section, domestic stocks. This first chart, I believe, is from Bloomberg, looks at the forward price to earnings ratio of the Mag 7, excluding Tesla. And what we see here is kind of a round trip from a valuation standpoint, from pretty high forward price to earnings levels to, back to kind of average of the last 15 years.
Yeah. Pretty remarkable, this chart. We were talking about it offline, but it basically shows that, any narrative that existed for the last several years where one could say the Mag 7 were so overvalued compared to the medium stock, as you can see here, is just simply no longer the case. And the reason is that the median stock has done very well of late, and the Mag 7 has continued to grow earnings, right? But hasn't really done as well for the past really 4, 5, 6 months.
But what they're doing, even with all the money they're spending on CapEx, they're still cash cows. They're producing cash flow, which we mentioned when people were starting to compare this technology narrative to the tech bubble back in 99 through 2000. And it's different because they are producing tons of cash. And again, taking a step back, high oil prices, who does it not impact the most domestically? Is the United States technology companies. They're impacted, but not as much as many other sectors of the economy. Moving on, looking at consolidated equity positioning, and I guess the takeaway for me here is people are not over their skis on risk, and at the same time they're not necessarily underinvested. It's a neutral reading.
Reading, and you can see it has rolled over a bit here recently, which you would expect, but at the same time, we're kind of in that middle of the road point where there's not a whole lot of evidence to suggest that this sell-off is any more than any other sell-off that's occurred over the last, several years. And as we've discussed, I mean, with the exception of oil now being higher, which is a headwind, albeit not a definitive negative across the board, things haven't changed a whole lot.
Next chart goes along with the net short on the prime book chart we looked at earlier. This just shows the skew of calls and puts. Calls are when people are anticipating stocks going up and they buy an option. Puts are, they're anticipating the stock price to go down. And what this shows us is people are really hedged, as they're protecting downside to a great degree.
Yeah, the market is not positioning for upside, at least not in terms of this measure, but it is very protected on the downside. So what we can often see is that even if one did have a negative view for the market over the next, say, 3, 6 months and beyond, in order for the market to go a lot lower immediately with this in play, you're going to need to see the movement on the downside really start to pick up, which usually would involve headlines continuing to get worse and worse and the market responding negatively to that. And, as of what, Friday the 13th today, we've actually seen that slow quite a bit, really just this week since Monday.
Yeah, I mean, you had boats getting hit in the Strait of Hermes and the market. We talked yesterday, Justin, on Thursday, and I was, all the headlines and all the news, both economically and geopolitically, and I was shocked the market wasn't down more. I mean, it's pretty resilient, and part of that is it's already in the price. People are already hedged. They're anticipating downside, and that in of itself can put a damper on the move down, right? Next chart looks at small caps relative to QQQ, the NASDAQ 100. And again, we talked about this, small caps breaking out, broadening of equity participation and up moves. And well, again, screeching brake sound. That's went the other way here recently.
Yeah, I mean, one of the catalysts that we've talked about coming into this year that you really need for small caps to outperform and start to get that sustained rotation from the big companies, money moving into the small companies, you need lower to stable oil prices. You need a good amount of, fiscal support and or economic growth, and you really have to have a very certain environment for that not to be the case. And, we had a bit of that for the last 3 or 4 months, and it's very much rolled over. So looking at this chart, we think the evidence would suggest, at least in the market, that the big long-term decline of small companies relative to the big ones is still in place.
Moving along to non-US market dynamics. This chart looks at dependency on energy imports, and you see Japan imports 90%, Korea 85%, the top 5 European countries 78%. So it's not surprising to see these countries stock markets react more violently than the United States has, for instance.
Yeah, and, coming into this year, there was a big kind of flow dynamic that we've talked about where money was moving into emerging markets. It was moving into, Korea in particular on kind of the AI theme around that. It was moving into Japan. And what we think is likely going to be the case here in the next, we'll call it quarter or two at least, would be that if oil prices stay remotely above where they were coming into this year, we're going to start to see a little bit more divergence between some of these different countries where, countries that are less dependent on oil imports should do marginally better, if not a lot better than those that are dependent. And as you can see in this chart here, several of the ones that are the most dependent on net energy are some of the recent really high performers, which just means there's probably some fast to medium fast money that's in there that might reverse and come back out. And looking back at the US and the valuations of that prior chart, the Mag 7, there's no group of companies in the world that's more career risk friendly to put your money than Mag 7.
Yeah, that's
We know that.
which I mean, we saw the entire South Korean stock market. I mean, it dropped like 10% in a day. That's it's a big move. And you see the US down here -7, meaning we're net energy exporters. So the entire dynamic with Iran and blocking the transportation of oil doesn't impact us as much. Next chart looks at China. And as we've mentioned, their government's been trying to stimulate for a long time, but their consumer continues to weaken.
Which is really pretty remarkable in that if you look at these data points that come out of China around the consumer, you basically just kind of increasingly see this theme that the only thing driving the economy is exports to what was mostly the US, but now very much other parts of the world as well, and government stimulus. And it kind of seems really difficult to imagine what's going to get the consumer out and about spending like the American consumer does. And, some of that might be culturally, but a lot of it might actually have to do with the whole demographic dynamic in China, in that they had, everybody only has one child and now the parents are old. And because real estate's been a speculative asset class, even with big price declines recently, real estate's still expensive, especially in the cities. So you've got a bunch of, career oriented single children living with their parents and supporting them.
With a lot of real estate, right? Which
Yeah,
necessarily
with a lot of
it's hard to spend real estate,
yeah.
You can't yeah, I mean, what I'm just saying it's an interesting dynamic that's more longer term in nature. You can't necessarily trade on this or make decisions, but it's really important to be aware of this. Next chart looks at Latin America, specifically their currencies relative to the US dollar.
Yeah, and the blue dot here is basically each Latin American currency and its move over the recent 5 days, which I think this is as of Wednesday or Thursday of this week. So, what you can basically see that with the big oil shock, it didn't really do a lot on the negative to these currencies. And what you see here in the black dot is that's how much these currencies are up over the most recent 12 months. So, although one could expect that if things get a little bit more risk averse, you could have some selling here, but the evidence continues to indicate that a lot of these flows that have gone into emerging markets in general, and specifically some of these mentioned here, are much more structural and less speculative.
Next chart, compares two emerging market ETFs that trade in the US, the EWZ to which is Brazil to South Korea. And that's again, it's another chart that caught my eye ahead of time that I talked to Justin about. That's a both of these markets have went up quite a bit, but yet, according to this, Brazil is still substantially undervalued relative to South Korea.
Right. Which, again, to your point, they've both gone up a lot. And it would perhaps make sense that over this period of time, Korean stocks have done a lot better than Brazilian stocks because Korean stocks have benefited in the manufacturing around AI and memory chips, et cetera. But if we think that at least near term, maybe we're going into a period of time where oil exporters or non oil importers have some relative strength, Korea is a huge, referring back to the prior chart or a few charts ago, Korea is an enormous energy importer versus Brazil is not.
Moving on to interest rates and credit. First chart looks at the market's expectation for how much the Fed will cut this year. And as of today, Friday the 13th, anticipating one rate cut in 2026, which is a big difference from less than a month ago.
Big difference. And that really comes with the oil spike, right? So that kind of complicates the expectation for central bankers to do anything. Not that they're necessarily going to hike rates based on oil going up. We kind of saw that in the 2022 episode where oil had already peaked and it was all the other inflationary indicators that started to move up. But a lot of that was, in hindsight, seen as bottlenecks from COVID. But at the same time, the market is no longer comfortable expecting there to be two rate cuts this year if there is an inflationary impulse back into the system.
Yeah, it really puts the Fed in a tight spot with again, marginally weakening labor market, right? But with inflation, a major input to inflation's number being oil going up, it puts them in a can't win situation where they can't cut to stimulate and support their dual mandate of a stable job market with inflation coming in hotter than they would like. And
And
again, it's a really
yeah,
tough spot.
one, to put a global context on that, the European Central Bank is different from the Fed in that they only have one mandate. The Fed is employment and inflation. The European Central Bank is only inflation. So you look at something like this oil spike, that not only takes rate cuts off the table for them, that actually kind of forces the market to start to think about potential rate hikes. And
Yeah.
that's a completely different story. And the same thing goes for all these energy importer countries, right? They were in a sweet spot, Japan, South Korea in particular, in that they were having a boom in exports, but yet their import costs were basically much lower than they had been, years past. And it was like, what do they call it? Goldilocks, right?
And
Versus,
think about what that does to the dollar if the Fed is holding and all these other major central banks possibly have to hike. I mean, it changes a lot of things from an asset class standpoint and expectations.
and if you look at the high interest rate economies that are left out there, we've mentioned like Brazil, for example, being probably the poster child, but there's others in the world as well. It ultimately just means that catalyst for their economies might be delayed because they're not going to be able to start cutting rates, which was going to be a positive. But it also means they've already got rates very high, so they might just hold them there longer. And if you're betting on a economic uptick, you might have to wait, but you'll receive some interest in the meantime.
The next chart looks at the 10-year US Treasury yield. It went down to the bottom end of a pretty substantial range, and really quickly it shot back higher.
Really quickly. So this has been a painful market if you've been trying to buy or sell so-called breakouts, right? Because basically, you look at this chart going back for quite some time, it's just really sideways, but in a pretty big range when you consider how many basis points that actually involves. So, which, yeah, I mean, again, what is it? A push and pull, right? Between
It's back to oil prices, right? If oil prices stay elevated, then inflation comes up, then that's going to drive the 10-year higher, which is then going to drive corporate financing higher that are tied to the 10-year US Treasury. It's going to drive mortgage prices higher. Mortgage rates hit a 11-month high this week. So again, the 10-year is a big deal, and that is a sharp move in a short period of time that slows a lot of things down. Yeah, it's good if you're looking to buy 10-year US Treasuries, but everything else in the real economy, not so much. It's not very good.
Globally, right? Yeah.
Yeah. The next chart looks at credit spreads. That's the difference is if you're buying a 10-year US Treasury, you're buying a 10-year lower credit quality corporate bond. How much premium do you need above the yield of the 10-year US Treasury to buy it? We've talked about spreads, being low, being suppressed. Well, they've started to poke their head up here. They still haven't broke out of what's been a long-term range, but starting to peak higher, and that's something we pay attention to.
Right. So there's all these different ways that you could look at this. And, one could even say that this is probably less of a real time indicator because of the whole dominant impact of like the flows into this particular part of the market. But regardless, you can see that there's not a lot of additional reward for risk given to you in corporate credit. So transition that to the next chart, and you'll see that when spreads are this tight, as you can see here, your 3, 6, what is that?
And
9 and
12
12
month
month returns are pretty negative overall, right? So,
historically. Yeah.
historically, right.
Oh, that's from BlackRock. I found that this week and I just thought it was a great visual to show that, okay, the yield may be slightly higher than you'll get on a US Treasury, but historically, your forward total return for taking that risk is, for the most part, deeply negative. And, that's back to paying attention to what you're buying. What's the, okay, you're 60/40 stocks to bonds. Well, what comprises the 40? Because that can matter in the grand scheme of things. Know what you're buying and know what your true risk exposure is. Moving on to the next section, our final section, looking at commodities. First chart is just the price of WTI crude oil. And, I was worried, Justin, that we would go an entire chart overload without your artwork, and we got it. Thank you for that.
The yellow
And
crayon.
what we see there is a deep horizontal line going back to 2007 that oil just touched.
Yeah, whenever markets are moving a lot in the immediate term, sometimes it's important to take a big, long zoom back. So, as you said, this is basically almost 20 years of looking back. And as we've seen, there's been a few times oil has really spiked up into this territory. It's been on big shocks, whether it was the giant China global boom that happened, into the global financial crisis, which, referring back to our prior comments on China, the world is very different in that regard. Or it was, the invasion of Ukraine and most recently shutting the Strait of Hormuz. I believe you pronounced it Hermes, which
Well, I
I
was
believe
thinking
that's
about a
I believe
purse
that's
my
a
wife's
designer.
dreaming
Yeah, I was
about.
gonna say that's a designer handbag. So someone's dominated by the wife. But yeah, we've gotten about all the worst possible things that could happen priced into oil. Now, not to say that there's not a scenario where it does go higher, but what you can see in that chart is the world has evolved a lot in terms of how much oil supply can come out there, in that, US shale didn't exist some of these last times that oil spiked up like that, right? And at the same time, we're all familiar in some form or fashion of what's going on with Venezuela. What really encourages the oil majors to get down there and get that oil is higher oil prices. So,
Yeah, and I mean, this is back to the supply dynamics we've talked about. What's different now than, the run up to the financial crisis in the late 2000s was supply and demand, right? The Chinese demand expansion isn't there, nor is it really there globally. And we've got way more supply, and higher prices drive some of that supply to come online, right? That's, to Justin's point, almost historically recently has put a cap on oil prices. So again, to be determined, but we have to respect long-term horizontal lines. Final chart looks at copper. Again, a different story than oil, other than they're both up, but it's corrected a bunch, but it's stayed up.
yeah, right. And copper's kind of a completely different story than oil in many regards, but it also, when you zoom out and look at the 20-year chart, it's a very different chart, right? In the sense that you basically see the fact that it is over that long period of time, despite its ups and downs across cycles, like finding a way to make new highs, basically, when oil is really doing the opposite. And anytime you have a long term chart between two things that look that different and a very pretty coherent supply demand narrative as to why they do look different. It's worth keeping an eye on, especially when near term volatility happens. And it's as simple as supply for copper is more challenged than supply for oil. And relative to what it was going forward, the demand for copper is likely to be higher than it was for oil. So that's a big picture theme we think is important, right? What's happening with both of those.
Because they're both important to the global economy in, different ways. But yeah. Well, we appreciate you joining us. We hope you took something away from it other than English is my second language. We'll be, we'll be back in what
Hermes.
is it?
When the
Yeah,
Strait of Hermes
go. Well,
shuts,
I
you
was
better.
thinking I need to go straight to Hermes if I want to make my wife happy, right?
Okay. Yeah.
Anyways, we'll be back in 2 weeks with another chart overload. Appreciate you spending time with us. If you have questions, you want to dig a little deeper into any of the topics we talked about, info@sollinda.com, info@sollinda.com. Appreciate you spending time with us. We'll see you next time.